Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
All right, folks, good morning. Let's take a look at how markets wrapped up last night on Wall Street, and we've got some green on the screen. The S&P 500 ended the day up 1.1% and closed at 6,446. The Nasdaq Composite was the outperformer, rising 1.4%. And we've got the Dow Jones Industrial Average adding 480 points or so, 1.1% up to 44,459. So the S&P 500 and the Nasdaq have hit new highs. And that's on the back of a tamer than expected inflation report, which raises the possibility that the Fed could cut rates next month. So let's check in now with Alex Morris. He is the CEO and CIO of FM Investments. Alex, how are you doing today? Good to have you on.
I'm glad to be back. I was looking forward to taking a holiday until I heard the session earlier today.
Okay. We'll let you on your holiday soon enough. But first, let's get help to unpack what's playing out in the markets. And it does look like we are in quite a good mood when it comes to how things are playing out right now. New highs yet again, a bit of momentum going on. How much optimism do you think there is right now being priced into the markets with what's going on with tariffs, what's going on with everything in the White House? What do you make of the momentum right now?
So I think there's a lot of retail investor optimism, and that's why you're seeing levels where they are and new highs hit in the S&P and the NASDAQ. Definitely different mood, though, starting to come from the analyst desks. More discussion of slowing growth, stagflation is picking up in those analyst notes. That was a word that we forgot about for a couple of decades, but reared its head a few months ago, went back away. We're hearing more of that now. So I think we're seeing a bit of a bifurcated mood from the average person, average retail investor who is seeing that nothing bad has happened to them quite yet. Prices don't seem to be moving that much. The inflation report was tamer, as you well noted. But practically some of the more professional investor side, we're starting to see a change in their mood. And we think some of the pricing is based on optimism, but we know that every recession, every drawdown starts from the peak. And this is starting to feel like we're getting closer and closer to the peak.
Okay, why is it that divergence? What are the analysts seeing that perhaps those on Main Street are not?
I think the analysts are looking at slowing growth and trying to look out over the horizon, which is a dangerous art form in financial projection. Even the Fed well pointed out, all the projections have been wrong historically, so why pay attention to them? But I think we look at the inflation number that hasn't fully reacted exactly as we expected. We look at the unemployment number. We look at some of the wranglings at the BLS, firing the leader of that, where now some of the data is going to start to come into question, and just other metrics that in general don't seem to have the same enthusiasm that they had 6 months ago. They're all a little tamer. And on the whole, I think the temperature is coming down a bit, and that's what many of those professional analysts are starting to feel and what they're starting to forecast.
All right, talking about the temperature coming down a bit, we've been tracking what's been playing out for tariffs. So it does look like we are seeing deals being done. So would you say we are now over the worst of it in that sense, where you now have perhaps the markets already past what might have been even worse situation, tariffs now? There's more clarity in the air in that sense.
I think there's certainly more clarity from what the short run is, but we always remind folks that a lot of these deals were done on a handshake and a relatively short stack of paper. It takes years to fully negotiate these. We certainly see that rift coming between Japan and the U.S. today, as Japan has some different recollections of what might have been said. Donald Trump has certainly asked for a substantial amount of foreign investment into the United States. Those numbers are easy to promise. None of that cash has actually showed up on U.S. shores yet. It'll take years to materialize. So I think the market seems placated by, okay, most of this are behind us, but we think it's going to take a long time to actually see any of that come to fruition. And we think very little of it will play out exactly as the headline tweets have made it out to be.
Yeah, talking about things coming into fruition, Donald Trump has also signed an executive order allowing the 401k retirement funds to get access to private markets. What do you make of that? Is it going to be a good lift for markets in time to come?
I think it's a great boon for private markets who've been looking for access to primary source of retail investment wealth, which is your retirement funds. Retail retirement funds in the U.S., unlike pension funds abroad, do allow a lot of discretion for independent investors. And this is going to give access to that. We wonder, though, is this the best way for folks to access those deals? Things that are by their nature 5-year, 10-year lockup, long-term investments make a lot of sense for young retirees or young investors who will retire 20, 30 years down the road, but they're in a structure that requires day liquidity and day pricing. And so our concern is less, are some of these good long-term prudent investments? They may well be, but the structure of how this has come together, the fact that it was an executive order that was kind of foisted on the market quickly, it didn't go through the usual review process and peer vetting that most of these rule changes do, leaves us to worry a bit about implementation and will it actually end up being owned by investors who are the right ones? And all of this has been done so quickly, no one's had a good chance to really vet that out.
Yeah. So perhaps a good boon, like you pointed out, for alternative assets like crypto, privately held companies, and so on. But lots of details yet to be hashed out. All right, let's take a look at your investor playbook right now. With all that we've been talking about, where are you leaning towards when it comes to your allocation?
We've always wanted folks to remain well diversified and it's time in market, not trying to time the market. And that certainly has proven fairly successful recently. We still like the short end of the curve. T-bill and chill is still a reasonably good trade, but we're starting to see folks and start to recommend moving more towards the belly of the curve as we see rates coming. We think September is a great opportunity for the Fed to cut, and it's good for folks to get in ahead of that trade because when you show up just in time, it turns out you're already too late. The credit space, we think will get a big rally from that, and it makes sense to be there. The equity market for that percentage of your portfolio, it's expensive, and it's hard to tell folks, wow, this is a great time to get in. But we probably would have said that 3 months ago or 6 months ago, and we would have been wrong then too. So here, the trend has been a little bit of your friend, and we think moderation in those equity expectations and being well diversified, particularly as things get rocky, particularly as we start to hit this rate cutting cycle, which might be done for slightly different reasons than the last 2 or 3 cycles we've seen, will be the savior of all of this. I think whether it's your 401k account, but you want to put all in crypto now and you might be able to, being well diversified is probably the best antidote to whatever the market's going to put it.
Yeah. So we are seeing that new highs being hit on Wall Street every other week. Is that also, I suppose, in line with what you're talking about, diversify to the rest of the 493 away from Max 7 just to spread it out?
We like that trade coming into now. The last 2-3 weeks, most of those new highs have been hit, though, on concentration. Max 7 and a handful of adjacent stocks have been really driving this, whereas most of the other names have been kind of left behind, which is one of those worry signs for us where the market is flashing. This isn't a fully shared rally. It isn't just enthusiasm for every stock. It's enthusiasm for a select few and the biggest ones. And certainly some of those names have been in the news, making tariff deals, cutting other trade partner relationships that, may backfire. So here we think you probably want to diversify away from just equities. Bonds are your friend here. To the extent that you want a little bit of crypto, that's, your mileage may vary, but take that with a small dose and be happy when overall you're making money. Don't look to make money every day by just calling the right stock every time. It's impossible. And it's in the long run, it's very stressful.
All right, stay diversified. And of course, lots happening in the coming months to track with. And we've been in conversation with Alex Morris. He's the CEO and CIO for FM Investments. Alex, thanks for your time and always great chatting with you. Thank you again for your insights.
Thanks, Ryan.
All right, we'll catch you again next time. Stay at Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.